Welcome, friends. In this series of discussing different financial jargons or simplifying financial jargons, today we have chosen topic capital gains and indexation. So, first of all, what is capital gains? A gain or a profit or appreciation in value of any capital assets is a capital gain. Suppose we have purchased any equities like equity mutual fund or direct stock or bond or a real estate. After some time, when you sold it, you realized some gain. So whatever is gain or surplus amount from the purchasing cost is capital gain. And of course it is of different type. So we'll see. So first thing is capital gain is nothing but appreciation in asset value of that particular assets for which we are talking or doing research or maybe investment has been done. Capital gain are of two types, short-term capital gain and long-term capital gain. Short-term capital gains are those, especially for equities, which are sold before completion of 1 year. And for equities, it is taxed at 15%. And any capital assets, especially equities, which is sold after 1 year, it will fall under long term capital gain and it is taxed at 10% of the this profit or gain amount or appreciation. Earlier, there was no tax for capital gains tax for equities, but now we have to pay. For bond or debt instrument, debt mutual funds, up to 3 years, it is considered short term, and beyond 3 years, it is considered long term capital gains. And for long term capital gains, we have to pay 20% of tax with indexation. Without indexation, same like equities, we have to pay 10% of amount as a tax. For short term capital gains, we have to pay as per our slab, once slab. Now here one new word came, indexation. So what is indexation? So indexation is a cost adjustment, or we can say if we inflate the price of something to suit the present price is indexation. For example, if you have purchased a equity share or equity mutual fund, say couple of years back, 2 years, 3 years back someday, and now you have sold that. So there is chance of capital appreciation. You will get some profit. So this will be your capital gain of today. But cost of acquisition 3 year, 5 year back, whenever you have purchased that one, was of course lower. That was of that term, that year term. But this time, this year term, present value. So there is inflation that also has played their role to adjust this. Cost price of acquisition is inflated of present year so that we can get actual appreciation. Suppose you have purchased a share for 100 rupees. Now you sold for 125 rupees. But during this period, there was effect of inflation. And if we see for present term, if it is 125, that means there is profit of only 25, actual profit. And tax will be for this actual profit. And that is taxed at 20%. So this is indexation. So how this is done? It is done through cost inflation index. Government of India publish each year how much inflation is, and accordingly we have to adjust. See, for this year maybe it is say 480, and when we purchased that year, that CII or cost inflation index was 305 or 325. So how we will done? If cost was 10,000, then we will multiply 10,000 by today cost, today the CII 480 and divided by 305 or 325. Then we will get actual inflated cost or indexed value as of present year. And this value was subtracted from sold value, and the difference will be profit. And on that profit part or on that capital gains only, taxation will be done. That will be taxable amount and taxation will be done. So we have to see in context of present value, and then only this applies. Or cost inflation index plays crucial role in deciding amount, and it is published by Government of India each year. If you find some value of discussion, please like and share with your colleagues and friends so that they can also get knowledge out of this. Please share your comments also so that I can read, and whatever your suggestion that can be applied. Thank you. Bye bye.